It's great to have you here on the Clark Howard Show. You know, our mission is to serve you with advice and information that empowers you so you make better financial decisions in your life. And I get so many questions about college expenses and how I love for parents and grandparents to save in 529 accounts. But how do you make sure you're saving in the right plan for you? I'm going to start today's show talking about that. And later, gosh, I can't believe it. I finally have some good news on the car insurance front. It's about time, right? So, saving for college is like climbing a mountain, and you're not a mountain climber. I mean, it's tough. And the good news is that the peak inflationary cycle, this has nothing to do with the recent cycle of inflation, but the peak inflationary cycle we've had in college education for the last many decades, where the cost of college has gone up at, I think it's 3 times the general rate of inflation in the economy, that is over, because Americans have changed their mentality about college. And there's also demographic reasons that colleges now need you more than you need them. So colleges that have always run what I refer to as cost plus operations, where they've never cared about what it was doing to the student and the families and the loans they might have. The colleges just said, oh, well, this is what it's costing us to run the place and need a little reserve here, and we're just going to charge that, whatever it is, and forget the details. And my middle daughter and I were talking just 2 days ago about how many of her friends, she's 25, Steffi's 25, how many of her friends are just overwhelmed by their student loan debt that they accumulated in college. And they question whether it was worth it because it has been such a burden. And so this has led to a psychological shift in society. First, yes, long-term, most college degrees, over a working lifetime, you make a lot more than you would otherwise. But there are a lot of other perfectly valid choices that will give you the opportunity to make a really nice living. And I'm looking forward to talking about some specifics on that on another podcast soon. But the fact that colleges don't have people psychologically over a barrel anymore means that those charts showing that if you have like a 3-year-old, that 15 years from now it's going to be $4 million for your kid to go to college for 4 years, don't believe them, because they're extrapolating future increases in college costs based on what they've been over the last 30 years that have been brutal. By the way, those college costs, going back to those student loans that Steffi's friends are just overwhelmed by, do you know that if we hadn't made it so easy in the United States for people to borrow money at 18, 19, 20, 21 years old to go to college, if we hadn't opened the money spigot so much on lending that created those burdens on people as they grow up, college costs would have never gone up like they did. It's funny it's a freaky thing, it could be in Freakonomics, that having so much money available through lending from the federal government is what created the wave of inflation in college costs, because it ended price sensitivity at the time someone's enrolled in college. So having said all that, still going to cost a lot of money, a pretty penny, for a kid to go to college. And that's where 529 plans come into being and into play, because they allow you to save money for college tax-free, spend it tax-free, and These plans, there's beauty and there's beast. Okay, how do you know beauty? Almost always, any what's known as direct sold plan for a 529, overwhelmingly, they have really reasonable costs and no commissions to go into. On the other hand, the beast is a lot of people make a brutal mistake. They buy a 529 plan through a commission salesperson. Not only are you going to pay huge commissions going in, you're going to pay much, much, much larger expenses over time. And a lot of years, you'll have less money in the account than you had at the end of the year than you had at the beginning. So know that thing. Only buy what's known as a direct sold 529 account. Now, on direct sold plans, more and more states around the country are offering incentives for you, for your employer, to offer money to you matching what you're saving in part for a kid's college in a 529 plan. And there are a handful of states that even offer tax credits to the employer for sending money your way to save in a 529 plan for your kid's college. And that's fantastic. A lot of incentives. And the rules made it more favorable for a grandparent who may have more resources than parents with all the expenses of raising children. A grandparent now can set up a 529 plan and not harm a child's eligibility for financial aid like they did before. The grandparent would have a plan they own for the benefit of a grandkid. A parent can also have their own account for benefit of a child, same child, 2 plans. And I have at Clark.com a guide we work hard on of the best 529 plans in the country. Shop that guide to make sure you're not throwing money away with a high-cost plan. Because I want the money working for you, working for your kid, working for your grandkid, not lining somebody's pockets at a big company with massive fees and commissions coming out of your wallet going to them. How do I feel about that, Christa?
All right, we'll go to questions now. This is from William in Virginia. Just a heads up, a few months ago you mentioned when using Kayak or any third-party travel service to get a good airfare, you now lose the reward points from the airlines. I fly twice a month from Virginia to Florida on American mostly, and I've been using Google Flights for years. Well, guess what's happening now? You don't get any points if you use Google Flights. User beware. Open up a separate tab and buy the flight directly to get all your points. Cheers from Vienna, Virginia.
So thank you for mentioning the follow-up, because a lot of people might not have heard it when I talked about it before. When I talked about it, it was about American Airlines doing this, American trying to get you to buy direct channel. The move around the rest of the industry has not followed American that I'm aware of yet. In fact, it's funny, there's been kind of a move away from that. Southwest, which never was listed on any sites at all, now is listed on Google Flights and other alternative ways of finding Southwest flights and fares. So the industry is going 2 directions at once. But if you are a loyalist to American Airlines, know that you should do what William is doing now. You can look third-party sites to see the best deal. And if it does happen to be on American, they will punish you if you don't restart your fare booking on American's website and booking there.
Anna,
One more thing, I'm sorry. With Kayak and Google searches, be very wary of UFO booking sites. A lot of them are really sleazy, or they're plain out, just plain crooks.
Okay, Anna in Montana says, my new employer offers a 401k Roth, which sounds like you love. Now we have the option of a Roth 401k or regular 401k. I'm eager to make the most of what I'm offered. A little background, I'm 33 and married. My husband has about $50,000 in his SEP, and we each have a Roth IRA with about $50,000 apiece, and my current 401k has $70,000. I always thought that with our Roth IRA, we haven't had enough tax diversification, and I should keep the 401ks traditional, but now I'm questioning if I should start the Roth and forgo the traditional. If I start doing a 401k Roth, do you recommend rolling a regular 401k into it, or is that even possible? Thanks for all your advice.
All right. Well, this is so timely because I am about to prove that I am the dullest person ever. We were having a staff meeting of staff from, Clark.com and all our different operations. And I was all animated and excited talking about what? The 2025 tax brackets. And I could see, because on the Google Meets, people are looking at me like, man, you're a loser.
That's not true.
Oh, they should. But this is relevant because you know how I say repeatedly, Roth 401k rather than traditional, Roth 401k rather than traditional. And it's all about tax brackets being unusually low right now based on historical numbers. And so the number that's the decision maker basically is for your married couple. If your income is below $400,000 a year, which is almost everybody is a married couple, you want to do the Roth 401k option. If you're making $200,000 or less as a single individual, you want to do the Roth 401k option. The reason is your tax bracket you're in is 24%. Your blended tax rate is more like 21, I think, 20, somewhere in there. And so you're likely to have, because of the accumulated federal budget deficits and what we're deficit spending every year, we're likely later in your life to have higher tax rates, even if your income is lower later in retirement. And that is an educated guess, and that's why I would say you do the Roth 401k.
And then can she roll the traditional 401k into a Roth?
Would not do that. Leave it as it is. Because you then have to pay tax on it. And there are advantages to you having money in both piles, but overwhelmingly having money in a Roth. Unless, if you're making as a couple more than $400,000, then you want traditional.
I think it's Renata, I hope I'm pronouncing that correctly, in Oklahoma, says, what are your thoughts on, and they name a specific RFID blocking card you can put in your wallet against RFID. It sounds like a reasonable offer. You can buy two, get one free for $40. What are your thoughts?
All right, first of all, that's way too much for one you'd put in your wallet. These things, if you go on Amazon.com, eBay, Walmart.com, you'll see tons of them available for much less money where you do protect them RFID-wise. Also, when you get a new wallet, overwhelmingly the wallets available for sale now are RFID wallets that protect that signal. And if you're not familiar with why this is important to Renata? Okay.
Gosh, I hope
sorry
that's right.
if we
I'm
butchered
so sorry.
your name. Please forgive us. You look at your credit cards. They all have pretty much that 3 half circle thing. And that means they're sending an RFID symbol for tap to pay, which is actually a superior way to pay now because it sends randomized codes that means that even if a criminal is hacked into the payment terminal, they got nothing useful. But they also send out a signal that a crook with an RFID sniffer apparently can capture information from your card. I'm not smart enough to understand how that works, but that's why you have the RFID protectors. And you can, if you love the wallet you have and it's not RFID, you can order one of these things ultra cheap and protect your cards. So coming up ahead, it's weird to have good news on car insurance because the news on car insurance has been the worst of my lifetime over the last few years. And the cycle has turned. I'm going to tell you what it means to you and your car insurance prices. We have had a perfect storm to our disadvantage as drivers for the last 3 years. It's been brutal with the auto insurance premium increases. We have heard from people who, my premium quote was 41% higher, and I had no tickets or accidents. Mine was 18% higher. And it's year after year, these premiums have gone up, 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 and away. And I started talking about this in earnest back in the back half of 21, that people were seeing these big increases. And there were a number of things that happened with the supply chain issues, people driving like lunatics, with office workers working remotely and the roads were not as busy. So people were driving like every day they were an Indy 500 driver, but without the training. And so the single vehicle accident rate during that cycle of office workers working at home in 21, 22, and 23, oh, man. I mean, it was off the charts. And then, because people were just driving recklessly, driving too fast. And so now we've got traffic again, which normally you think of, that's what's going to cause the wrecks. But the slowdown in speeds with more traffic has actually been beneficial. It doesn't prevent fender benders, but prevents a lot of the horrific accidents. Second, when somebody's car was totaled, or SUV or whatever, in an accident over the last several years, what the insurance company was having to pay out was far, far higher than they'd actuarially set premiums for, because the cost of used vehicles had gone through the roof because of things. If you're a longtime listener or viewer, you heard me explain what was going on with the three big car rental conglomerates, Avis, Hertz, and Enterprise. And so they disrupted the market. And then the lack of production in new vehicles, because of supply chain issues, led to a big run-up and put price pressure on used vehicles that went crazy high. So then the insurers were having to pay much higher claims when a vehicle was totaled, because they had to pay you market value on your vehicle. Then, the fun's not over yet. So then, let's say your vehicle was repairable, but the time to repair it went much wider, much longer, and because they couldn't get the used parts, the parts to repair your vehicle at the body shops, and the cost of insurance replacement rentals tripled, because vehicle rental costs went way, 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 way up. And then the body shop repairs were much more expensive. Every one of those things has changed. And it's not like a light switch, boom, boom. But if you think of it more like a rheostat, every trend is your and my friend right now. The used vehicle prices are much lower than they were earlier in the cycle of the last 3 years. So you got that going. The body shop backlog is greatly reduced. Still not where it was in 19, but still better. The cost of renting a vehicle way down, as I experienced, because I rent about 30, this year I'll rent about 35 cars over the course of the year. And so all these factors, plus insurers are earning money again, where they weren't earning any money in fact, they were losing record losses. And so they're profitable again. So we're moving from a profitability cycle for insurers to fighting for market share again. That's always beneficial to consumers. So there's you know how so much of inflation, where you just say the damage is done, even if the prices have started leveling out, there's already much higher prices. The auto insurance thing actually goes through peaks and valleys. And you now, this is state by state, and it may not have happened yet in your state, but when your renewal comes up, you'll find it'll be really useful to shop around, because you very well may find that premiums are going down on renewal by shopping around rather than just not going up as much at renewal. I've got a guide at clark.com. It's simple, it's clear, how to shop for lower car insurance. Take advantage of it a few weeks before renewal time to see what your best deal will be going forward.
Okay, we'll go to questions. This one's from Debbie in California. I'm a retired teacher. I have several credit cards that I pay off monthly. I haven't had a balance in over 25 years.
Wow, good for you.
I recently bought a car and put the down payment on a cash back card. I had saved the money, but I figured why not get the cash back? When the bill came due that month, I paid it off. My credit score went down by quite a bit. I don't care about that because I know my spending habits. It's the principle of the thing. And I've been deluged with offers to, quote, clean up my credit. How do you clean up a credit score that is 829 and that's at its lowest point?
So first of all, you are absolutely a perfectionist. You must have been somewhere close to 850. 829 is still way golden. Anything above 780 is considered to be golden credit. But what happens is the reason you're getting those things saying, oh, your credit is in trouble, isn't it? Is they subscribe to services provided by the credit bureaus that tell them whose credit has fallen by whatever the block of points is, assuming that somebody is now in distress and they should be solicited for whatever.
Lori in Texas says, we've had our insurance company for our home, auto policies, umbrella policy, and residential rental property for 3 years. I noticed that my discount program was not applied to my vehicle with our renewal. I called and found out that the beacon in my car had died, so they mailed me a new one. I went to their app, and when it wanted me to consent to the end user license agreement, under your privacy section, it states that by using the app, I am voluntarily allowing them to collect many types of information from me. I was dismayed to see contacts listed. I understand that it wants to collect my name and contact information, but they're now collecting my hundreds of contacts that I've saved on my phone. Have you seen other insurance companies collecting this info? I feel this is a major violation of my privacy, and I plan to forgo the discount or switch insurance providers. I don't want to switch to another company and find out that all the other companies are collecting my contacts as well.
So it's actually worse than that. So when you see those end user agreements,
it's impressive that you read it.
Yeah,
to say.
Nobody reads those because they're typically over 150 pages. They're boilerplate. They're written by law firms to try to limit lawsuits, class actions by just their waterfront policies. So they may not actually ever collect your contact information. And this is across, I'm telling you, you look at almost any app, anybody who actually takes the time to read it, you'll see they're asking for everything. Plus, I mean, they might as well put in it that they're taking your children from you, because most people would never read it and see they say that. But they include every possible thing in these waterfront agreements. And so do they have an intent to do that? No, but if something happened and accidentally they did, they're trying to prevent suit. It is because we do not have in the United States a national privacy law. Like even a lot of developing countries now have these laws. Every other developed country, I think, in the world has privacy with data, except us. And so that's the thing. The real problem is these apps are written, the user agreements are written in a way that is totally one-sided. So if you thought you'd have a victory switching from them because they're doing this, I'm afraid you would find as a general rule that even potentially the same boilerplate language would be in the user agreement for all the other insurance company apps that track your driving.
But in light of what you've talked about, do you think it's a good idea to shop around anyway?
Well, yeah, I mean, that's it's kind of like my answer to every question is you should have a Roth IRA.
Freeze your credit.
Yeah, freeze your credit. It is a great idea, at least every 3 years, to shop your insurance. And your particular insurance company is legendary for loyalty penalties, not loyalty credits. They use a loyalty score system, and if they see somebody who tends to be very loyal as a person, they charge you higher premiums than people who the loyalty index score finds are people that are more likely to be free agents and shop around.
Paul in Massachusetts says, my wife and I are discussing the distribution of our assets after our deaths. We have 2 adult daughters with very different lifestyles. The older one's divorced, no children, lives in a small rural town about 2 hours north of Seattle, owns her own home, of which we pay about half her mortgage, and has a very modest income. The younger daughter's married with 2 young children, lives in a multi-million-dollar suburban home in a very upscale community, and has family income of $350,000 to $400,000. Our issue is that my wife wants to evenly divide our assets of slightly over $1 million, while I would like to make an uneven distribution, giving a larger share to the daughter with fewer assets. We respect your opinion and would like to hear your take and suggestions.
Wow, Paul, you want me to be a Solomon here. All right. So there's a couple of things that I can mention to you, and there is no right answer. You're not right. Your wife isn't right, because every family dynamic is different. When my late mom, did her last will about 15 years before she passed away, she turned to me because I was with her at the lawyer, and she said, I want to tell you in her thick Southern accent,
Darling,
that I'm not going to give you anything from my will because you're good. You've got enough, and so I'm not going to give you anything. And I was cool with that. And I've heard and I've read that you want to talk to your kids while you're alive and explain the reasoning that you've had for how you're going to do it if it's not with 2 kids, even distribution of your assets. And so telling somebody up front rather than them finding out later is, I think, a very important thing to do, because then they can ask you questions. And they might ask you questions that might make you think, maybe I should do this instead. Then there's the other thing, the big state, small state compromise. So in a case where you have family members who have different needs because of what's going on in their lives, if you think back to when they were in Philadelphia writing the Constitution and they had this big split between the small states feeling like they were going to be overwhelmed by the big states, that's why we have equal representation in the U.S. House, but every state by population in the House, but the Senate is not equal population at all. Every state gets 2 senators. So the idea is you take half of your assets, split them equally, and the other half do a different ratio to give more to the daughter who does not have the enormous wealth. And that way you end up with a blend of what your wife wants to do and what you want to do. And that's more a compromise between the 2 of you. But if you did a big state, small state compromise, what then you would need to do is, again, explain it to your kids while you're living. And you're already doing a lot for the daughter who lives north of Seattle, paying half the mortgage. I mean, you're being very generous as parents along the way, and your wife supports that. And maybe she'd be happy with the idea of half of it split equally, the other half skewed one way or the other. Just trying to come up with a suggestion, because there is no right answer here. There is no one answer here because families are interesting and every family has its own energy fields. How's that for a new agey kind of expression?
I mean, I think that's correct.
So
I don't know that it's new agey.
That's not new agey,
No.
saying energy fields. Anyway,
Not to me.
not to you.
I'm very woo-woo.
Should we have some crystals and shake them up?
I have crystals at home.
What do crystals do anyway?
I mean, some people think different crystals give different energies off, that they represent different things, and yeah.
You're way past how a
Yeah.
literal person like me could understand. Okay. Anyway,
You'd say that's a bunch of hooey.
I would not because I am so I'm so literal. I'm so whatever side of the brain that is. What side of the brain is that?
I believe that's the right side of the brain.
I'm so right side.
No, left side,
Left
because
side.
left-handed people are more creative. But you're left-handed like
I am left-handed. But I would never sell short somebody else's beliefs. They're just different.
Yeah.
Okay. So that having been said, remember that tomorrow is a special national holiday, Christa's birthday. And one of the gifts I'm giving you tomorrow in the podcast,
What?
I'm not singing.
Oh, okay, good.
Yeah, that's painful to hear me sing. But between now and tomorrow, I want you to know that we got so much available to help you. One of the things we have is we have the ability for you to get free one-on-one advice and guidance. And if you go to clark.com/CAC, you'll be able to see how 30 hours each week you can get that free one-on-one advice to help you save more, spend less, and avoid getting ripped off. See you tomorrow.